Are you looking to understand your monthly mortgage payment? Well, hello, I'm John Thomas with Prime Residential Mortgage. I'm going to cover everything that's involved in your monthly mortgage payment. So your monthly mortgage payment consists of paying back the money you borrowed, which we call the principal balance, and the interest charged to borrow that money. This is commonly called your principal and interest, or P&I for short. The actual payment is calculated based on how much you owe, the interest rate on your mortgage loan, and the term of your loan, which is called the amortization period. So let's review an example. Let's say you owe, your principal balance is $200,000. Your mortgage interest rate is fixed at 5.5%, and your amortization or your term is 30 years. So the monthly mortgage payment of principal and interest, or P&I, is $1,135.58. The total mortgage payment is broken down between the principal and the interest, but it is not equal. The mortgage is front-loaded for interest. If you look at the example on the screen, there's a table showing sample mortgage payments at different months broken down for the amount going towards principal and the amount going towards interest. So if we look at it, in the table you can see that most of your mortgage payment is going towards interest even in the 5th year, which is the 60 months. You don't get to half and half until the 210th payment. After that, you can see that at the 240th payment, more now is going towards principal versus interest. Some good news is your very last payment, the 360 payment, the total is slightly less than $1,135. So you've been paying for the last 29 years. So you get a slight break at the end of your mortgage loan. What is PITI? Well, your monthly mortgage payment will typically include not only the principal and interest each month, but also the property taxes and the homeowners insurance. So this is abbreviated principal, interest, property taxes, and homeowner insurance. It's PITI. When you are budgeting for a mortgage payment, or your mortgage loan officer asks you how much you want to spend every month on a mortgage payment, this is what they're asking, your PITI payment. So the PITI is the part that's going towards the lender to repay the mortgage. The taxes and insurance are collected by your lender and held in an escrow account. So in order to calculate your PITI payment, the lender will use the principal and interest rate and the term to calculate the P&I part, just like we showed in the example before. In order to calculate the TI part, the lender will take your yearly property taxes and divide those by 12 months, and also take your yearly homeowners insurance premium and divide that by 12 months. So if we look at the same example from before and add in the property taxes and the homeowners insurance, it would look like this. You've got your $200,000 principal balance, your mortgage interest rate of 5.5%, the term is still 30 years, the monthly mortgage payment for P&I is $1,135.58. Now if we take yearly property taxes of $2,400, divide that by 12, that's a $200 per month for the property taxes. Now let's say your yearly homeowners insurance premium is $600, so we divide that by 12 and that equals $50 per month. So now your total mortgage payment of PITI is $1,385.58. That's your PITI. What if you have to pay mortgage insurance on your mortgage loan? Well, if your mortgage lender requires the mortgage insurance, which is MI for short, then your total monthly payment is now PITI plus the MI. The mortgage insurance is required when the loan is a riskier loan for the lender, so the lender requires the borrower to purchase a mortgage insurance policy to protect the lender in case the borrower were to default. The premium for the mortgage insurance policy is paid by the borrower, so it's added to the monthly mortgage payment if it's elected to be paid on a monthly basis, which is called borrower-paid monthly mortgage insurance. If we look at the example we previously reviewed and use a monthly mortgage insurance premium of $1,041.67, the monthly mortgage payment for PI and TI plus the MI now equals $1,527.25. The mortgage insurance is typically required on conventional loans if you're putting down less than 20% of the value of the home. Now, FHA loans and USDA rural housing loans always require mortgage insurance no matter how much you put down. VA loans do not ever require mortgage insurance, even with 0% down.